Hello, I'm Dave Clayman, and welcome to a March 20th, 2023 edition of In Clayman's Terms. The purpose of these videos is to make things more understandable, less frenetic, less biased than you might see elsewhere, and bring it to you in Clayman's terms, layman's terms. So, wanted to talk about the current situation going on in banking, in financial markets, and what it might mean for the foreseeable future. I've had a number of questions come up since the failure of Silicon Valley Bank and Signature Bank. Silicon Valley Bank was a result of a couple of factors. Number one, because of regulation passed in 2008 under the Dodd-Frank bill, banks were required to hold all of their investments in treasury securities or mortgage-backed securities and no longer allowed to invest in corporate bonds. What this meant was treasury securities go down when interest rates go up, as do mortgage-backed securities. Corporate bonds actually are typically floating rate, meaning that they can pay higher interest rates as regular interest rates go up, and therefore the value of those bonds don't necessarily decline in the same manner or at the same speed as values of treasury bonds. Because if you own a treasury bond that is paying a 2% coupon, let's say, for over the next 10 years, and you can get 5% interest, your 2% bond is not worth as much as it once was. So Silicon Valley Bank's assets were in these treasury bonds that had declined significantly in value as a result of the interest rate rises. If they were able to hold their assets until maturity, then that's not a problem because the treasury bond will pay out at par and they will get their money back. However, the bank was forced to start to raise money 2 weeks ago, on Wednesday, and that caused them to need to sell these treasury bonds at significant losses. This started from the basic crisis of confidence. As I've said to a number of people over the last week, It's a Wonderful Life basically played out in real time. The whole premise of banking is that a bank is required to hold certain dollar amounts on their balance sheet in order to cover withdrawals while they lend the rest out to hopefully creditworthy clients. The typical reserve requirement is about 20%. So in other words, for every dollar that you keep on deposit, you can lend out $5. What happened with Silicon Valley was that they were not getting deposits from their clients at the same rate that they had expected or projected when they were making those loans. In fact, they actually started seeing withdrawals. When that happened, they fell close to or even maybe slightly below their reserve requirements. The only way to increase their capital then was to sell their assets. Those treasury bonds that I mentioned had declined. Well, they took a pretty big hit. About $1.8 billion was the initial estimate. And when that happened, people got scared. There was concern that the bank was in trouble. And large investors started withdrawing their deposits. Well, as we talked about, there's only 20 cents on the dollar in the bank for every dollar that's loaned out. So when the depositors start withdrawing money en masse, you start getting worse and worse, and it just continues to spiral. $42 billion was pulled out of Silicon Valley Bank a week ago Thursday in just about 4 hours. So it is likely that the regulators knew that Silicon Valley needed to raise capital, that they were up against their covenants for loans. And on Friday morning, when they saw how quickly the deposits were being withdrawn, they decided to step in and stop the withdrawals, close the bank basically, before it got to a point where they couldn't control it. Once they did that, and the FDIC guaranteed deposits above $250,000, clients' money was restored. However, it uncovered another issue that was out there, and that was that of uninsured deposits. So as many people know, for every individual taxpayer in every account at every bank, you're insured by FDIC up to $250,000 limit. Meaning, if you're a couple, you can have $500,000 in the account, but it is per taxpayer ID. So if we have 5 different accounts at Silicon Valley Bank and they total $700,000, even though there's not more than $250 for each person in any one account, those are accumulated and need to be counted together. So $200,000 of that couple's money would be, quote, uninsured. 94% of all deposits at Silicon Valley Bank were above the insurance limits. That's why it became a problem. When people started thinking about the possibility that their money would be uninsured, they started withdrawing it rapidly. This has now spread to rumors and concerns at other banks and people to look at and assess their situation. Do I have a large percentage of my deposits that are uninsured? That is causing additional capital to be withdrawn out of those banks, spread around, some placed in treasury bills, some placed at other banks. But that is causing other banks to lose their deposits. That's where the current concern lies. The Federal Reserve has opened up massive liquidity to banks over the last week, allowing them access to what is called their discount window. And banks have taken advantage of it in order to shore up their deposits and make sure that they don't have a run on the bank that leaves them unable to raise capital at a time when they need to, or at a time when it would be less profitable for them. So in short, what I'm saying is that in the short run, the Federal Reserve and other regulators have made our banks more liquid. What does that mean for the other big concern this year, inflation? Well, inflation is and always has been a case of too many dollars chasing too few goods. So if we're increasing the liquidity within the system, it makes sense that the Federal Reserve would continue their campaign against inflation and raise rates by 0.25% on Wednesday. I know there are many that are hoping that they do not. However, it is our belief that those are people that are not looking at the big picture. They are looking at potential short-term gains in the stock market and not looking at the inflationary pain that could come from ignoring what is out there because of the mishap that happened with Silicon Valley Bank and others. So it is our view that the banking system is solid, that the Federal Reserve and other regulators have made the correct moves to ensure the stability of our banking system, and that the Federal Reserve should continue with their campaign of interest rate rises so as not to, quote, kick the can down the road and have a larger inflationary problem to deal with later. We do own some bank stocks within our portfolio. We are very confident in those holdings. We continue to review them, and we believe that we are in good shape. If you have any questions or concerns, you can feel free to reach out to me at 12 Points, Dave at 12points.com, or your direct advisor. Thank you. We hope all is well in this concerning time.